Operation Choke Point is caused, I think, primarily by good intentions. The FDIC exists to protect depositories, and that fund is not infinite. The FDIC, one of its purposes, whether it's stated or not, is to protect the fund that protects depositors. So there's lots of ways to do that, and there's lots of ways to calibrate how conservative and how protective you really are as a regulator. One of them is to swing the pendulum way to the wrong side, way to the conservative side, and say, look, we are going to functionally outlaw businesses or working with businesses as a bank, working with businesses that are too, quote, risky. And those risks are not some amorphous sense of, it's not some amorphous feeling. They're actually categories. There are written, documented categories of risk. And one of those categories is reputational or headline risk. It wasn't originally a category. It's something that was created by, I think, a well-intentioned federal regulator, someone who you would cynically call, one of those darn bureaucrats, but it's really just trying to do the right thing. Because realistically, that is a risk, right? A bank can fail because of reputational concerns. What had happened is that regulators started using that category of reputational risk as to bludgeon anything that could potentially threaten the fund. If you're going to be cynical, you're going to say, well, it made their jobs easier, but it made America worse. It made their jobs easier because those companies were really those companies that could have threatened the fund were never in a position to threaten the fund because they never got accounts in the first place. But from an economic perspective, you zoom out and you see this is like, it's kind of tough to get banking in any industry in the United States that pushes the envelope. So what had happened, practically speaking, is that the regulators of the banks would tell the banks, hey, this account here has high reputational risk. It's threatening your solvency because if something goes bad with this account, something could go bad with you. And that is rife for abuse, right? If that sounds too discretionary to you, I would agree. I think you're right. I think it is too discretionary. It gives entirely too much discretion to regulators to do what protect their reputations, not just the bank's reputations. And you can see how that's a real moral hazard. You can see a runaway, and that's the story of the United States de-risking over the last few decades.
You're listening to CFB Talks Digital Assets, the home of informed conversation about crypto for institutions building the future of finance, presented by CF Benchmarks. Hey everybody, thank you very much for joining us for another episode of CFB Talks Digital Assets. I'm Ken Adeliger, and I'm joined as usual by my colleagues Mark Pilipchuk and Gabe Selby. Today we have a particularly special episode. Our esteemed guest is Marco Santori, who's the Chief Legal Officer of Kraken. So Marco, what's top of mind for you? I mean, there's a lot going on. What is catching your attention as being most interesting and potentially being most impactful down the line?
Yeah, I think that right now, one of the biggest forces that's moving is on Choke Point 2.0. At the bottom of every fintech stack is a bank. And just like everything in nature over a long enough timeline tends to evolve into something that looks like a crab at every level, fintech companies tend to evolve into banks. And that's this like immutable law of the American banking system. And I would argue not just the American banking system, but European banking systems and others that are similar. It's the case for them as well that, where the real money is made is in seniorage. And it's difficult for banks to make money without fractional reserve lending. Kraken Bank does it differently because they have a different profile, right? They can do just plain custody, but look at PayPal. I mean, PayPal ended up being a bank. I mean, it just like this is what happens to fintech companies in the United States. So because of that, if you can clean up that base layer, that's a monumental shift in the way that fintechs work in the U.S.
Well, Marco, welcome to the podcast. It's a real pleasure to have you on. I really want to dive into this choke point 2.0 narrative and kind of get your takes on things. And certainly we saw the repeal of SAB 21 recently. Hopefully that has an impact here with the industry. But just jumping back into kind of like this debanking situation that we saw with the prior administration, I'm just kind of curious, in your view, how can regulators address this issue of debanking and ensure that, crypto platforms and these other businesses that were targeted have access to essential banking services without facing all these undue restrictions or discrimination going forward?
Yeah, it's a good question. I mean, you look at, I think, the root cause of these sorts of things. You have to, right? When it comes to choke point 2.0, the root cause at this point is become better understood than it has been at any point over the last 30 years. Maybe even longer than that if you talk to the money transmitters, right? The remittance companies, they've been facing this for a long time, but, certainly it reached fever pitch with the Patriot Act. And we've been living in that life ever since. But the cause of Operation Choke Point 2.0 is the federal regulator that's behind it, right? Lots of folks in crypto like to talk about ending the Fed. But really, the perpetrator here is not so much the Fed as it is the FDIC. And we've seen dramatic change start to move across the FDIC for a number of reasons. Certainly, there have been cultural problems within the building, but I would say that from a choke point 2.0 perspective, we're seeing a dramatic shift in the way that Americans think about banking and they think about how access to banking happens, and certainly American entrepreneurs.
I think, looking ahead, do you see that there's a need for more transparency and accountability on regulators going forward that had this kind of undue influence and made this more arbitrary kind of decision to just shut off these companies from access to our financial system? Or what would be kind of like an example that you would give to kind of move us forward, after such an kind of incredible event, really?
It's a good question. Having now explored the causes together, right, we can talk about the solutions. I would always favor more transparency for our public servants, right? Our government is a powerful thing, particularly in the United States. More transparency is better. More accountability is better. There's a good reason, though, why that's lagged in the banking sector. It's because of this concept of a run on the bank. What we want to prevent in the United States, and frankly, any banking system anywhere, is a run on the bank. We want to prevent the erosion of confidence, because an erosion can turn into a landslide. And for better or for worse, we still use and need our banking system today in the United States. Crypto is growing, but it's not doing the job of the banks just yet. And if we get this wrong, if we permit the wrong things to enter the public sector through governmental fiat, right? If we give banks a requirement of disclosing commercially secretive information of the wrong kind, if we require them to do that, we threaten the bank and we threaten its depositors and we threaten those of us who use banks, right? So we have to get it right. Just saying we're going to throw the thing open and sunlight is the best disinfectant sounds good. Probably doesn't work. So what are the structural things that we can do?
So I was going to ask,
Number one, you just eliminate the concept of reputational risk. It is rife for abuse. Its risks outweigh its benefits. I should say its detriments outweigh its benefits, right? Its malices outweigh its bonuses. There's no world in which you can trust any human being who's trying to keep his or her job as a regulator, or, let alone actually get promoted in it and advance his or her career, right? There's no world in which naturally, healthily, self-interested people can be given that much power to determine what is a good reputation versus a bad reputation. That's not something we do in the United States. We have a Bill of Rights that's set up not to punish people based on their reputations, right? We have amendments for this. To give that kind of power to a federal bureaucrat is in my view, preposterous. And it should be step one, is to eliminate this concept of reputational or headline risk.
Structurally, as you were saying, and legislatively, that would be the first step. That would be the essence of whatever device or apparatus legally is set in place to actually begin to remedy the problem from your point of view. Just thinking about, what this bill would look like, basically.
Yeah, so it's not clear to me whether it needs to be a bill, whether it needs to be an act of Congress. I don't believe the FDIC is so constrained that it can't fix itself. So this is a top-down. This is a set of top-down reforms that can be spurred on by Congress. It can be spurred on by the Treasury. But at the end of the day, the FDIC is its own corporation. It's chartered, right, by the federal government. It has its own federal charter, but it is a corporation. It has its own internal rules, and if it can change its rules and if it can change its culture internally, I think we can make real progress on banking for innovative companies in the U.S.
Is this a matter of then doing some executive orders or changing the leadership at the FDIC, or is that
we have both already, right? We've got new leadership. We have an executive order that calls for the FDIC to revisit its risk rating practices, or at least implicitly revisit its risk weighting practices, and to take a fresh look at how we can bank innovators in the U.S. That when, on behalf of my clients over the years, right? No particular client, but of my clients over the years, I have spoken to bank CEOs who have debanked them, and it has never been the case that the CEO comes to me and says, "Yeah, you know what? We don't actually like this industry. We don't think there's any possibility here. We just think it's a bad business decision to bank this industry or to bank your client." It's never happened. Always happened is they've come and they said, "We just had our exam. The regulators told us they thought you were high risk, and if we didn't shut you down, well, they were going to."
Wow.
That is outrageous.
Wow.
Frankly. Let's jump in and, to the main stuff. Top of mind has got to be, in terms of the chattering classes, is the strategic reserve. It's a massive piece. Again, we could probably have the rest of the conversation just on that. But from your point of view, what needs to happen? What are the hurdles that need to be surmounted for this thing to see the light of day? If at all it even can see the light of day, in your view.
Yeah. Got to win hearts and minds, right? But how do we do that? How do we advocate for something this new? The U.S. has strategic stockpiles or strategic reserves of all kinds of stuff. The U.S. does own gold, not just counterparty. It does not just custody gold. It actually owns its own gold. So that's an interesting mental model to think about with Bitcoin, or to digital assets more broadly, right? This has shifted from just the concept of a Bitcoin reserve to a digital asset reserve in the president's last executive order. He didn't say that the United States is going to explore the possibility of establishing a Bitcoin reserve, but he did say it's going to explore the possibility of establishing a national digital asset stockpile, which is interesting language in a number of respects, right? It's not going to do it. It's not going to explore it. It's going to explore the possibility of it, right? Which I think telegraphs a willingness to inquire, but also lays bare the state of the discussion, which is we're not convinced. I think that's where the administration is today. I think that they understand that it's important to a great swath of Americans, but they haven't fully wrapped their head around why, or whether that great swath of Americans is right. Hey,
Right.
We don't have a direct democracy here. We have a republic, and it's important that our leaders exercise their own independent judgment. This is one of those areas where, that again would be rife with abuse if the majority of the people could just decide that the United States was going to directly decide that the United States was going to write a giant check to buy a bunch of stuff, just rife for abuse. So here we've got an administration that is considering it and has directed the United States. It'll primarily be the U.S. Treasury to put pen to paper on a real plan to do it. So what happens in that process? Well, let's say they put the plan together. Let's say they can put a plan together and figure out the mechanics. To actually get it done, you got to convince people that it ought to be done. And that's the biggest hurdle, I think, today, is that mental model. Why do we need a Bitcoin reserve or a digital asset reserve? Is it like gold? Is it like oil? How does it fit into the mental model of previous reserves?
And in that same executive order, they also mentioned just a broader working group on the digital asset space. What are some of things that are top of mind for you that working group should focus on?
The working group is critical. That's how things are going to get done in the executive branch and also at the independent agencies. Top of mind are, well, one, Operation Choke Point 2.0, right? This is a meaty topic. Two, market structure regulation. This is something that's important for Kraken and for other exchanges doing any business in the United States. Three would be initial issuances. So the TGEs, right? What we used to call ICOs and have since shifted over the years with nudging from some of the people on this podcast right now. Tax issues are top of mind, right? If these things are actually going to be used as currency, I don't want to have to report de minimis changes on my tax returns at the end of the year. It's just silly. I would say KYC, on-chain KYC is another one. How do we better integrate the sanctions and know your customer rules into an on-chain environment? These are the kinds of things that I think are going to be top of mind and probably take the most work. Yeah. Thankfully, there's a lot of work already done on some of them. Choke Point 2.0, we know we got to do. We just got to get the political will to do it. Market structure. FIT 21 passed the House. There's a Senate version that's pending right now. The final version probably shouldn't look exactly like FIT 21. FIT 21 was a good start, but there's a lot of prior art there and a lot of good stuff. So, and the tax issue is, again, just a question of political will. Like it's silly to tell people they can buy things with USDC, but they have to report a 2-cent capital gain.
It's not consistent. It's not cogent.
Right? Crazy stuff.
With all that, we've talked about the executive orders, we've talked about the task force, and we've mentioned some of these bills, and there's a lot of moving parts that I think we're seeing develop. I guess, how do we make sure that, all this legislation could potentially align with, this broader framework, this broader vision that we need to build here in this country if we want to be, as stated by David Sachs, or the AI and cryptos are, the leading nation in cryptocurrency? Like, how do we get all these moving pieces working in unison, or is there going to be competition between these different working groups, these different, the task force, the SEC, the CFTC? Seems like there's just a lot of different groups that need to be involved here, right?
Yeah, well, that's why you put a task force together. You've got David Sachs, who is an SGE, or a special government employee, and so by law can only dedicate something like 180 something days to this. He's going to dedicate a lot to AI, rightfully so. Probably less to crypto, realistically. But I think I think both issues are super important. The way that the executive branch gets things done is by forming a working group, putting somebody in the White House in charge of that working group, and, asking for results within a certain time period. I'm optimistic. That we'll see something. The White House can ask all that of its own people. It can ask that of the executive branch. Tougher to ask that of Congress.
Do you think that this needs to be done relatively quickly then? And meaning that, I think we're in this honeymoon phase, just like any administration when they come in, the first 100 days, I think, and Dave Sachs has got a 180-day contract. Is that what you said? So is it very critical that they get started and they act quickly, or does momentum stall out later on as we get closer to the midterms?
I'm less concerned with momentum. And the 180-day limit is on how many days per year Sachs and other government employees, I think it's 183, but how many days per year they are permitted to work on these issues for the United States.
Yeah.
Right. But the U.S., the president has asked for results. He's demanding results on a timeline that is compressed, that is accelerated. And I think that's appropriate. There's no reason to delay on some of these common sense changes that, are pretty much consensus driven at this.
Yeah.
I'm mindful of your time, Marco, and we still have a couple of, quite meaty things we want to ask you. I think the main elephant in the room, if you don't mind me putting it that way, are these reports that you potentially could be a candidate to be the next chair of the CFTC. I mean, really have no idea about what you can say about that, but we've got to ask you.
Yeah, no, fair enough. I've been in crypto for 13 years now, advising clients, representing clients in front of the government, and having real meaty discussions with the government. I've never revealed the contents of those. I'm not gonna start today. But what I can say is that there's a fantastic opportunity today, now, to make real change, real impact on crypto, not just to right the wrongs of the past, but to launch this stuff into an orbit that's going to be up there for 1,000 years, and no ideologues or aggressive prosecutors are going to be able to pull down. This is a generational opportunity with all three branches of government, as well as a groundswell of popular support and really positive market sentiment. This is the time to make these changes and to ensure that they can't be undone by administrations of the future who don't value innovation. This is critical, in my view.
There is one other thing. This is a bit closer to the time, the horizon, in terms of potentially coming to fruition. You're probably aware of this, the NASDAQ and BlackRock, which obviously issues the most popular in terms of market cap Bitcoin ETF, spot Bitcoin ETF. A couple of weeks ago, I think, filed a proposed rule change to transition to in-kind redemption, from cash redemption, cash create redeem. That's now with the SEC. Clearly, there's not a great deal you can sort of say in terms of, the merits, but I'd love to hear your views, and maybe if you have an idea, or if you have a sort of an inkling in terms of the likelihood of approval, that would be great to hear as well.
I think they're very likely to be approved, these rule changes. There's no good operational reason I can think of why in-kind redemptions would be prohibited for Bitcoin, for the ETFs that exist. It's this extra step, this extra friction that, frankly, the last regime put in place for political reasons, as far as I can tell, for political reasons. And those can be effective temporarily. Those politically motivated changes can be effective, but they're not durable, because politics change, and politics have changed. There's nothing standing in the way of those now, at least from a principles perspective or from a policy perspective. It's just politics, and those are behind us now.
Around a similar time frame to all those, we also saw a flurry of filings for various ETFs for XRP, Solana, conversion to Litecoin. With those filings, do you think it's likely that we kind of need to wait for some more guidance out of the SEC, or is this just issuers getting in front of it? I'd kind of like to hear some of your thoughts on what a timeline might look like.
Politics are complex, and make no mistake, this is still while the politics have changed, there's still politics. And one of the things that the federal agency can do is take a step like listing an ETF, regardless of whether some of the underlying legal questions have been answered by courts. And by making that change, further embolden political change, right? So let's say it's not clear, hypothetically, whether an asset is a security or a commodity or a chosen action or one of the other types of things recognizable under the law. Let's say it's not clear. What the SEC or any other regulator, right, could do is to treat them as though it was one thing. So treat Sol as if it is a commodity, which I think is the correct interpretation, by the way. But one of the things that the SEC can do is treat Sol as though it is a commodity, permit it to be listed in a commodity ETF, and start building all of the mechanisms and institutions around that so as to encourage either congressional or even judicial in some cases, judicial review of this apparatus that's been built so that it's difficult to disassemble. ETFs are one way to do that. To build an ETF as though this thing is a commodity, make it kind of tough for folks to say that it isn't.
Yeah, absolutely.
Sometimes even the courts, it maybe shouldn't be that way, but sometimes that's the case. So it's bullish for sure.
Yeah, no, Marco, well, obviously we respect that you can't discuss any of these conversations that you're having with the candidacy of, potentially being, the future CFTC chair. But of course, as someone who sits on the sidelines and looks at the regulatory environment and tries to understand these changes or what the future might hold, we certainly value your opinion on these matters. And what I would like to ask you is, if we kind of close our eyes and look ahead and try to imagine, the way that the SEC will govern, their responsibilities, their purview of assets, and the way that CFTC will govern their purview of assets, how is there going to be enough clarity, definitive scope going forward so everyone in the industry knows and understands what's required of them? We can kind of foster innovation in the cryptocurrency space, which is ultimately, I think, what we all want, right?
Yeah. Well, the big question now, right, is which regulator ought to get jurisdiction over crypto? And I think the answer is no regulator should get jurisdiction over crypto. It's a huge remit. And crypto is not some monolithic asset class. Right now, the front runner for getting jurisdiction over markets in crypto is the CFTC. And that's the better choice over the SEC, not because, we hate who's in charge of the SEC or anything like that. It's because of a real practical reason. The CFTC and the SEC regulate differently because the statutes they administer are structured differently. The SEC is a rules-based regulator, whereas the CFTC is a principles-based regulator. In the SEC, in the world of SEC functional regulation, there's actually very little self-certification that goes on. There's very little that the SEC permits its regulated entities to do on their own without its approval. Not so with the CFTC. With the CFTC, there's quite a bit that functionally regulated entities, I should say entities regulated functionally by the CFTC, there's quite a bit that they can self-certify. And that's how things move forward in CFTC world. So there's some method behind the madness. That said, regulation should be technology neutral. And so if somebody is using a blockchain to raise capital for an enterprise whereby a bunch of folks are promising to exercise their technical and managerial expertise to deliver returns to an investor, it's no different than if someone's using a piece of paper to do that, or a Word document, or a PDF, or whatever, right? It's securities are securities. So the SEC should retain jurisdiction over core capital formation processes like selling stock, whether or not that stock is sold on a blockchain. So I think there's room for both of our federal regulators. Query whether we need two federal regulators in the United States. We're the only country that has one. We're the only country that has that split between the two federal financial regulators. Every country, every state in the United States has the single financial regulator. We're an outlier there, but we are good at bureaucracy. I'll give us that. So there's an argument to be made that, like, really in the long tail of this, maybe there ought to be just one federal financial regulator that applies to crypto. But then I think you have to ask yourself a foundational question: is all this really financial, or is there something else happening here? Right? For this audience, right, this is a financially focused audience, but there's more than that happening on blockchains. We have to be realistic about that.
Thank you so much, sir. Really appreciate you taking time out of your busy schedule to join us.
No, thank you so much for having me. This is a blast every time.
So there you have it. There's a lot going on, and we've actually got probably the best bird's eye view that we're going to get for the outlook for the legislative agenda, the future of, laws and regulations pertaining to crypto in general from, directly from a well-informed insider. So I hope you enjoyed that. If you like this type of podcast, of course, Spotify, Amazon, other podcast platforms, wherever you get your podcasts is where you need to go to listen to other episodes of CFB Talks Digital Assets. And our content can all be found at cfbenchmarks.com. Hope you can join us again for another episode of CFB Talks Digital Assets. Thanks for joining us.
Thank you for listening to CFB Talks Digital Assets. This recording is for informational purposes only and should not be considered investment advice. This recording is not intended to persuade or incite you to buy or sell any financial products noted within, including but not limited to exchange-traded funds, mutual funds, equities, other instruments that reference any index provided by CF Benchmarks Limited, or crypto assets. Any commentary, interviews, and discussions are opinions only and should not be considered a personalized recommendation. Please contact your financial advisor or professional before making an investment decision. Note, some of the underlying instruments cited within this recording may be restricted to certain customer categories in certain jurisdictions.